Our civic engagement project was on Payday Loans. My name is Joe Markey.
My name is Logan Dooley.
My name is Alli Post.
And I'm Luke Hitchcock.
So payday loans are short-term, high-interest rate loans, generally for $500 or less, which are designed to bridge the gap between paychecks. These types of loans are geared towards people who live paycheck to paycheck who may encounter financial hardships in the meantime and require cash fast. With these loans, minimal personal and financial information is needed, and there are a variety of sources from which one can obtain this type of loan. Unlike most loans, credit checks are not required, which is part of the reason they are appealing and easy to get for lower income society. Payday loans can be very costly. For example, a typical payday loan with a 2-week term and a $15 per $100 fee has an annual percentage rate of almost 400%.
So you might ask, how do payday loans work? Say you needed $500 to cover medical expenses that you did not have. You cannot receive a loan from any other bank as your credit score is too low, so your only option is a payday loan. You have to first sign a posted personal check for $550. This covers the $500 that you need, plus $50 in finance fees. You have to make this payable to the lender that you're borrowing from too. The lender in advance will forward you this $500 and you can go and pay your medical expenses. This period for this loan will be set for 14 days to 1 month. At the end of this period, you will pay them that $550 from either that check or a new check. And then there might be additional fees on top of this. If you cannot pay for this at this time, there will be additional fees put on top of this, and there will be another loan that you'll probably have to take out from them to cover the pay of the other loan, getting you in a vicious cycle.
Who uses these types of loans? Payday loans serve more than 19 million households in America. They typically affect people from the ages of 25 to 44. Now, anyone with a checking account can use a payday loan, which makes them widely accessible to a large amount of people. Statistics show that the typical borrower is a renter who makes an income less than $40,000 a year and does not have a college degree. The average borrower takes out 8 loans of $375 and spends $520 on interest alone by the time the initial loan is repaid. Although the consumer may need cash now, they will actually end up paying more money and losing hundreds of dollars than the loan that they actually took out.
So now that we've talked about what payday loans are and who uses them, let's assess some of the pros and cons. One of the benefits of payday loans is if you have poor credit score and are in desperate need of quick cash due to some kind of emergency that's come up, you can easily take out a quick loan and have cash available to you immediately. When used effectively, the loans can act as a viable solution to these types of immediate problems. Applications to take out payday loans are not fast and very quick, not strenuous at all, which make them very attractive to people who want to take out the money. If you do the applications online, it's an even quicker process. Most payday loans have credit checks, which is beneficial for those whose residential status or poor credit would disallow them from obtaining loans from smaller banks or other credit unions. Another benefit is the money that you borrow is available to you immediately, and you don't have to wait. So now that we've looked at the benefits, let's look at the negatives of these payday loans. First off, most of the payday borrowers will have limited financial flexibility, or else they wouldn't be taking out these loans in the first place. Next, the interest rates on these loans are exponentially higher than any other interest rate you'll see on another loan, and they average out to be about 300% at the term. Payday loans essentially encourage a debt cycle due to the extremely high interest rates along with the high repayment rates. These loans tend to have lender favorable terms, meaning that if the borrower is not able to pay back the loan in full, the lender has the ability to pursue legal options, which include collection tactics. Finally, the inability to meet your repayment terms will leave you in a tangled mess of debt. This chart represents the cycle that Logan had addressed. This shows the debt cycle that you could get into that leads you to require on payday loans to pay bills and to pay off them.
The average percent of people that use payday loans use it from 1 to 5 times a year for 30% of the time. 6 to 10 for 25%, 11 to 15 for 20%, 16 to 19 for 15%, 20 to 25 for 15% again, and over 25 for around 5%. This represents the high number of people that actually do fall into this debt cycle and are dependent on these types of loans.
Some alternative to payday loans. Now, the first off is you can negotiate a payment plan with the creditor. Now, if you have money that you know you're going to get in the future, you can get a fixed payment with him and solve it that way. Another way you can do it is charge the amount to your credit card. Now, if you charge your credit card at the beginning of the month, you will now have about 25 to 30 days to repay your credit card, which gives you exponentially more time than the average 2-week payday loan. You could also receive an advance from your employer. Now, this varies from person to person. It depends where you are employed, but it is an option you can explore. Another thing you can do is use your bank's overdraft protection. Now, if you overdraw from your checking account, you still have time to repay that amount, and you might get a small penalty, but it will be less than the interest rate that the loan will originally be. You could also obtain a line of credit from an FDIC-approved lender, which is another alternative to a payday loan because they also offer loans in their own capacity. You could borrow money from your savings account. A lot of people do not like to do this because they earn an interest rate and would not like to withdraw from that, but it is also an option you can explore. You could also ask a relative to lend you money. Now, this varies again from family to family, person to person, but if it's an option you haven't explored, you can try that as well because in the long run, it might be better than being charged interest from a payday loan. And if you weigh all of these options and you are still considering a payday loan, then make sure you use a trusted lender and only borrow as much as you know you can pay back. And also make sure that you shop around from the different payday loan shops and try and find the lowest interest rate that you can find.
So now let's look at what the government has done to try and reduce some of the impact on these payday loans. In October of 2017, the Consumer Financial Protection Bureau they released a regulation in requiring lenders to not only assess whether or not their borrowers could repay their debts, but they also capped the amount of loans that these lenders can make. The purpose of these rules was to greatly reduce the use of these payday loans, which critics say prey on the vulnerable with their astronomical fees. The Consumer Financial Protection Bureau and other federal regulators have been nudging smaller banks and credit unions to try and solve this problem. The Office of the Comptroller of the Currency lifted the restrictions on banks that kept them from making these small loans. And under the new regulations, the industry revenue is expected to plummet by about 2/3.
Today's impact on banks. Now, payday loans have come under scrutiny from politicians for their ability to lure customers into a debt trap. Now, as recently as about 1 year, President Obama came out and used these specific words of a debt trap to describe payday loans and their effect on today's consumer. This recent scrutiny has led to JP Chase, a bank that probably everybody knows, to announce new policies that limit the ability of online payday lenders to access bank customers' accounts in order to withdraw improper or unwanted automatic payments. Now, in short, this is essentially kind of a wall, essentially, for payday lenders where they cannot go into a consumer's checking account and withdraw the money that they are owed. This leads the consumer into the debt trap because they will get overdraft penalties and things of that nature. So JP Chase was the first bank to step up and create a wall for the payday lender. Now, JP Morgan has also declared that it will stop charging customers repeated overdraft fees in a single month. This is big news because essentially they're only making a couple $100,000 from this practice, and their market cap's about $380 billion around there. So it's basically just a small amount of money that they're losing off on, but it also creates a more pleasant consumer experience.
So regarding the civic engagement portion of this project, which was the main focus, we kind of looked how payday loans were geared toward the lower class working citizens, like I mentioned previously, who lack the sufficient funds and knowledge to make sound investments or manage their money on their own. Smith, who was living in Virginia, borrowed $1,600 plus more than $500 in fees, plus interest on each payment. Eventually, her salary couldn't keep up, and she fell further into the vicious debt trap. This is just a simple example of how payday loans create a great problem in the greater society as a whole by lending agencies preying on these less fortunate and uneducated individuals and scamming them into extremely high interest rate loans because they need the cash fast and they know they can get the people to take the loans out. This group of people does not realize how the loan will hurt them in the future by incurring all the interest payments, and it just kind of keeps putting them further and further into the lower class of citizens. If consumers were not tied so much to debt, but from misleading loans or advice they were typically giving from these lenders, there would be more spent in the economy, which would stimulate overall growth in GDP.
Some recommendations that we recommended to fix payday loans is for the CFPB to implement a basic pamphlet or website that borrowers could easily access and make it mandatory for anyone that wanted to borrow a payday loan to look at these and address the possible concerns and have knowledge and background of what they're getting themselves into. This should be put out in multiple languages to aid the multiple different languages of the borrowers that will be using it. This would be a minimal cost for the government, which would potentially save investors time and money, which would have more money to go back into the GDP of the country. This would also encourage small banks and credit unions to make smaller dollar loans to help their immediate community. An example of this brochure would look like this. It would say payday loans on the front and what you need to know. When you open it up, it would have what it is, what to know, and what to do, as well as an example of what can go wrong if you get into the debt cycle of a payday loan. That wraps up our project about payday loans. We hope it helped you with knowledge for the future if you ever get yourself in one of these situations.